Ladies and gentlemen, boys and girls, welcome to another exciting episode of All Things Litigation Funding. My name is Ted Farrell from Litigation Finance Advisors. And we are very lucky today to have my good friend, Kelly Daley from Gerchen Capital. Kelly, how are you?
I'm great, Ted. How are you?
I'm really good. In the rare event that someone listening may actually not know who you are, which I think would be very shocking, if you could give us just a little quick background, then we'll sort of get into it. But just a little quick about you, about Gerchen, and then we'll just get into it.
Yes, all five of us in the litigation finance community who watch this.
We have like 8 listeners. We have like 8 listeners, but they love it, and they will text you. They will write you a text message. So there you go.
Amazing. Good. I look forward to that. So hello, all 8 of you. I am Kelly Daley. I was a commercial litigator for a decade at a variety of big law places and a small law somewhere in the middle there, and then moved over to litigation finance back in 2017, which feels like the dark ages of.
It really was. It really was. Yeah.
Yes. I am the mother. No.
Right.
But I started off at Burford Capital in the commercial underwriting group, and spent 7 years at Burford. Over the course of that time, became the head of the U.S. commercial underwriting team and the head of the Chicago office. Learned all the stuff that we learned over those years as the litigation finance industry grew up. And
let me guess, it's a really easy business, right? It's really easy. There's nothing to it, right? There's nothing to it.
Right. I mean, I'm basically ready to retire, but this is a vanity project at this point. So I moved over to Gerchen Capital Partners at the end of 2024 and brought over the work that I've been doing for the last 5 or 6 years, first at Burford and now here, which is primarily focused on corporate monetizations, the new LitFin buzzword.
Okay, but more importantly, while I think it's safe to say that Kirkland & Ellis is the official feeder firm of the litigation funding industry, you did go to the official university that is the #1 feeder to litigation finance, which has, I think, the 9th best basketball team in the Big East, at least last year. You also are a Georgetown grad, is that correct?
Twice. I went there undergraduate and law school. And I was coached that I had to say that, and then I forgot it. So sorry, Ted.
It was in the outline. That's all right. These don't always go as we practice. Okay. So let's, I'm going to ask you one thing before Gerchen, because I do try to ask everyone this, because I think I told you, but people are sort of interested. What was the first time you were like either in a funding deal or like aware of a funding deal? Like, in other words, how did this business or this whole thing sort of get on your radar?
So I joked before about being at Burford in the baby stages of litigation finance, but I actually first ran into the industry in its earliest stages. I was briefly a plaintiff's lawyer of sorts in between some big law stints, and intersected with Burford Capital in possibly its first or second year of existence, and learned at that point about the existence of litigation funding, which at the time was LitFin 101. It was fees and expenses funding for single cases in relatively small volumes.
Mm-hmm. Interesting. Okay. All right. So I think it's, I really want to give you a chance to talk about Gerchen for a couple reasons, but I think one of the reasons is I think there's a lot of funders. So you go on the website and it says, we do anything and everything. And I think it's true in that I think a lot of funders will look at that, but you all have some very dedicated strategies, and in fact, you're not shy in the marketplace or known. So tell me a little bit about a couple of the strategies, but then I wanted to hear about the one you're running, which is, of course, the corporate monetization strategy that you've been, they sort of brought you over to run.
Absolutely. Yeah. I think the Gerchen website used to say less than it says now about what we do, because we have really broadened what, we've broadened a lot over the last couple of years with, several acquisitions of new teams and new pools of capital. But, effectively, Gerchen got its start as a secondaries fund. I think Adam can largely be credited with starting the litigation finance specific secondaries market in a organized and systematic way. We still do a lot in the secondaries market. We do a lot in the mass tort PI class action space, in the claim acquisition and marketing funding structures. And then with the movement last year of my colleague Patrick Wackerly over to GCP, we launched a post-settlement business that is specifically advancing and factoring on unsettled funds. So that has been the growth of GCP until my arrival, when we kind of added another bucket of capital and strategy, which I think broadly you could say is pre-settlement, which is like the entire litigation finance market, but then specifically focused on the corporate monetization strategy, which naturally bleeds into law firm funding and fees and expenses funding and sort of the whole pre-settlement world. But corporate monetization within that is a specific strategy and a focus of the fund.
Okay, so let's talk about monetization. And I have a great research assistant called Grok, and Grok is the AI on Twitter. Okay. Because I think there's this idea about monetizations, and so what does monetization mean? And so so let's talk about specific kinds of cases. So for example, is it fair to say that antitrust is a place where this happens, where you might have a well-worn antitrust conspiracy, and there's not really a question of whether it happened, but then there's civil litigation, it takes forever. So talk to me about, like, when you talk to corporates, like, what does it mean to monetize their claim in those cases? Like, what are we really talking about?
Yeah, absolutely. I hope I can do slightly better than Grok AI, but I can't make any promises.
That's fair.
I think.
Well, Grok gets better every day, though. All these AI tools are always better. Like, we're getting worse; they're getting better every day. So
this whole podcast will be fed into AI and regurgitated in a more coherent way.
That's true. That is fair.
Okay. Well, before the robots get us, I think when you're thinking about corporate monetization, the strategy broadly is to help corporations recognize that their contingent legal assets are financeable assets of the corporation. So what does that all mean? What it means is that companies are used to having financeable assets of a variety of forms. There's like physical assets like buildings and property, but a lot of it is accounts receivable and monetary assets that aren't realized but that are still financeable. But legal claims have never been one of those. You could never go to a bank and get a loan against a recovery that you're expecting to get in 3 to 5 years from litigation. And so what the corporate monetization strategy is to go to companies and say, hey, you actually can now do that in a way you couldn't before. You just have to do it in this very bespoke financial market with people who can actually underwrite the collateral and value the asset. And so corporate monetizations are bringing forward the value of legal claims, but not generally for purposes of funding the fees and expenses of the case, but rather for generating free cash flows for the business. So just financing the eventual recovery for the benefit of the business's cash flow.
Right. Okay. So let's just say that I'll just make something up. So there's been a price fixing conspiracy, and the manufacturers of widget X have pled guilty to an antitrust conspiracy, and I'm a manufacturer and I buy widget X. How long, if there's a class action hanging out there, is it fair to say it can take 5, 6, or 7 years to get paid? I mean, is that uncommon, or?
I mean, well in excess of 5 years in a significantly sized antitrust case would be very standard.
Right. And so the idea is you were harmed. And because what I'm really trying to get at is, this is different than if I came to you and said, hey, I have a business dispute and I think someone breached my contract, but we haven't had a trial, we haven't had discovery, we haven't had anything. Monetization, I think, is it fair to say that you're talking about things where something very clearly happened and sort of the battle about that is sort of over? I mean, is like when are the use cases for monetization?
I mean, I would love if every monetization opportunity I had was like a case in which established liability was, out there and you're guilty pleas. Like that's my dream investment. We certainly see opportunities to monetize earlier stage claims, breach of contract, things like that. That's all just a question of underwriting. You underwrite the risk, you underwrite the merits, and then you price for that risk. The more established the case is, the widget example you just gave, the more comfortable we're going to get in making an investment, the higher level of investment we'd be willing to make in terms of sort of LTV against the total value of the claim. And the lower the price will be if there's less risk of total loss. But I don't think there's any claim that's precluded from monetization. I just think, to your point, you see a lot more monetization opportunity in claims that are mature, that have some sort of track record of settlement, some indicia of value that allows you to get comfortable with the likelihood that you're not going to lose all your money.
Right. And what I'm trying to get at here is, and we'll talk about sort of the broad criticisms of the business. We can get to that in a minute because there's a lot of them and we'll talk about them. But, like when Bumblebee and Starkist, or whoever, pleads guilty to fixing the price of canned tuna, like the fact that people might want to monetize, it's hard to say, oh, you're just stirring up litigation, right? Like there's sort of like a spectrum that this goes on. And I think, and maybe you won't agree with me, but I think in these cases where there's really something that's just monetizing a claim, liability is large. In most of the monetizations, it's probably more late stage stuff where, kind of like, the skirmish is over about whether it happened, and really what you're getting at is really more about time and damages. I mean, does that seem, am I right there? Maybe I'm not.
No, I mean, I think there's more monetization in those cases because the risk is lower to the investor, and monetization, unlike fees and expenses funding, is a capital intensive strategy, right? You put a lot of money out the door on day one. You're not funding, fees and expenses over time, where if something goes wrong midstream, you aren't fully deployed on your capital. Monetization, you deploy day one. You don't want to get that wrong. So obviously we're looking for those kinds of indicia. And yes, to your point, a company that has been wronged in the commercial market has to wait a long time to recover even a portion of that harm, right? Antitrust cases settle historically for 20 to 30% of single damages. That means that the bad actors in those cases profit 3x off of even the settlement value of the claim, never minding treble damages, because those are just like.
But Kelly, you're the bad guy, right? For monetizing it, you're the bad guy, right? They might have violated like the Sherman Antitrust Act. It's only the Magna Carta of free enterprise from that Supreme Court case, but other than that, you're really the problem. You're the problem in this country.
I mean, I think what we see, antitrust cases are a great example because there's a lot of them, because there's large commercial claims, but they're also a good example of exactly what you're talking about, because there is a commercial harm in the market that, while our participation in it is largely business to business, the next layer of that harm is just passed on to consumers, right? Everybody knew about protein litigation, broiler chicken, pork, beef, turkey, all of the meats that like our children are growing up on got hugely more expensive over the course of a decade because of this alleged price fixing conspiracy. And for which I
think there were some criminal guilty pleas. Is that right? I'm not making that part up. Tuna for sure.
Yes, right. In tuna, there was, I think Tyson's had a DOJ
consent decree
agreement, and so there was pretty solid indicia that there was bad things that happened. Was it
happened?
Local was alleged in the civil case? Who knows? But the point is that the commercial plaintiffs in those cases are the direct purchasers from the producers. The producers are the people who like chop up the chicken and make it into like chicken breast from like an actual
right,
chicken.
and it goes to the store. Right.
But the person who the company that buys the produced chicken, the broken down chicken, is like the food producers of the world, the people who make like the frozen chicken nuggets that you buy from the grocery store. And so they're the direct plaintiff under federal antitrust law. But if they're overcharged, they just have to raise their prices to the consumer. And so
everyone's paying more, right?
Ultimately suffering is like the mom who has to buy 7,000 chicken nuggets a week because she has too many children. I have too many children, Ted.
You're doing like $7,000 a week on the nuggets. That's a lot. It's a lot of nuggets.
Chicken nuggets. Yeah. So
then the ketchup, and then if they fix the price of that ketchup, you're toast. That's it. You're not going to make it.
But bringing the monetization back into the commercial equation, when the chicken nugget maker is able to monetize their claim in real time instead of waiting 5 or 7 years for the recovery, they're able to price adjust in real time and to do that accordingly. And so it's really just, it's a time value issue. That's all.
And there's a time value of money. No, I think that makes total sense. And I think that, there's different attacks on litigation funding, but, when you're talking about sort of monetizations for these long running cases where there's settlements, the idea that like, funders are dreaming these cases up or something is just kind of silly. So anyway, okay. Well, I want to switch gears a little bit, and I want to talk about when you all meet a counterparty. So someone, they call GCP, and it can be a law firm, it can be a claim holder. Besides obviously the four corners of it has to be a real claim, they have to be able to prove it, all that stuff. I mean, what are you thinking about, when you're sort of picking who to go into business with? Because I think it's safe to say that, you all have been in business long enough, the team is experienced enough that, you don't have to say yes to deals if there are sort of, every objectively good deal is not a deal you have to do if there's subjective factors. So, what do you look for when somebody kind of makes, first contact and through the process, what are sort of the qualities you're looking for as people are thinking about this capital?
Well, certainly in the monetization space, we're primarily doing business with Fortune 500 and, increasingly mostly Fortune 100 companies. And so a lot of the risk around the claim, in addition to obviously underwriting the claims themselves, is you have to look at the credit risk of the counterparties, the corporate culture around affirmative recovery. I mean, remember that 10 years ago, plaintiff was a dirty word to any Fortune 100 company for the most part. Right. So we're really seeing a shift in that kind of thought in the market, where companies are more than ever recognizing that they have to assert their affirmative claims. They have to recover the ways in which they were harmed. And so you want to work with a company that has that clear culture of affirmative recovery, because you don't want to be in a situation where there's not the right incentive to litigate, where there's not a fulsome willingness to recover the damages that they were harmed, as opposed to like these sort of mealy mouth settlements that used to happen where people would throw away huge value of a claim because they didn't want to be like in a business dispute with a distribution partner or something like that.
Right.
But now there's this idea that, well, you have a fiscal obligation or fiduciary obligation to your shareholders, and
and that, by the way, like I will say, like that has been the turn in that, and especially, I hate to go back to that, but I mean, in these big long running cases where there are huge damages, if you're not looking at it, you're kind of asleep at the switch. And like, it doesn't mean you have to do every monetization deal, but the idea that you're not, thinking about it is, look, it's hard to find a business in America that doesn't think they're underfunded or under the gun. And, if you have a valid claim about some sort of nationwide problem, at least exploring what monetization looks like or what bringing suit looks like, look, they stole the money, they overcharge you for a reason because they thought they get away with it and they took money out of your pocket and, maybe you have to go get it back.
Yeah. Yeah. I think we're going to see, that shift continue and there to be even more of a reckoning where executives are held accountable for not pursuing recoveries that would have inured to the financial benefit of a company. Allowing yourself to be harmed is not a business decision that people are free to make now in a way that they used to be. So I think that changes the terminology for sure. But that's certainly, those are kind of early reads that you get on a company. Is this a company that's willing to aggressively pursue its appropriate recoveries? You want to look at the credit risk of the organization. I think that there is certainly a risk shifting element to the monetization strategy. In other words, companies coming to you and saying, we like this case, but we're not really sure it's going to be successful. And I don't want to be responsible 5 years from now if this is a zero. So I'd like to take some money off the table now, knowing that that money is going to cost me something. But it means that there's no zero in this once we've committed internal corporate resources to it. And I don't have to, have egg on my face later. So we have that conversation sometimes, right. But I would say it's far more often that companies are just coming to us and saying they have a cash flow need. We have a fiscal year end problem. We overspent on a defense case that we weren't expecting. We were defendants in a big class action. It wasn't in our budget for this year. We've blown the legal department's budget. Don't make me go to my CFO with these numbers. Help me. Yeah. Those are the conversations that we're most often having. And I actually, to me, those are the best counterparties because they're motivated by exactly the principle I started with, which is your contingent legal assets are financeable assets of the company. Treat these like any other financeable assets, and let's generate some cash flows for your business. The thing that's nice about this capital that you won't find in other financeable assets is that there's no gap treatment for contingent legal recoveries, right? So you're taking an asset that has no current book value, you're creating cash flows, and you're creating cash flows in a non-recourse financing agreement that doesn't come off as debt. So you took your baseline zero, you brought in cash, and there's no there's no offsetting debt.
Yeah, I mean these are classic. They're classic liquid assets. So let's talk about taking the zero off. So and we're not going to talk about insurance today because it's been well worn in the space and it's important. And we all look at wrap deals and some work, some don't. But I think what's often forgotten is people say, oh, I want insurance to take risk off. But what you were saying earlier is, funding is the risk transfer, right? Because you were going to pay 100% of the cost for 100% of the recovery. And so we're really, the funding is an allocation of risk too. So how do you think about, de-risking law firms, de-risking counterparties, and where do you like the balance? And everyone, I know you're going to say we want everyone aligned, but how do you think what are sort of good ways to think about that as you're going in with a law firm that might have a bunch of claims or a company that has a bunch of claims?
Yeah, law firms, I think, approach this very differently than companies. Law firms with a large contingent book are used to assessing risk. They're used to taking on risk. They're used to holding risk. If they are coming to the litigation finance community, and obviously this isn't universally true, there's law firms that are financially distressed, or there's law firms that aren't used to doing contingencies and aren't comfortable with them. But if you're looking at the typical firm that does a significant amount of contingent work, is used to holding risk, when they're coming to the litigation finance world for money, it's generally because they need to scale, right? Because the nature of the contingency is you're holding risk and you're holding a sort of uncertain amount. quantum in terms of how much you've invested and duration and
the duration. And we're gonna get back to duration because that's a big one.
That's the one, right? Like that's what we all struggle with in this asset class is duration. And so I think a lot of law firms, they're having a hard time swallowing the duration pill. We are still pulling ourselves out of the post-COVID court delay hole. You're seeing just the pace of litigation slowed down by complexity and volume and all of that. And so the law firm conversation is generally about like, how do we hold slightly less risk right now so that we can scale? Because we need to be able to keep taking new cases in, because otherwise there's going to be a whole 3 to 5 years down the road from now because we sort of paused on taking risk. So I think that the risk shifting conversation there is very much about scale. With corporations, it's more, the financeable asset free cash flow issue or the egg on your face problem that like no head of litigation wants to go say to their GC, like it was a zero.
Right. And I think too, the thing that I think is one of the best parts about this business is structure wise as an entity, a law firm needs current year revenue because that is how monies are distributed in partnerships, and funds are built to assess and hold risk over time. And by the way, be paid for eating that risk, right? But so as the law firms are not built to take long tail duration risk. And when you all go on the road and talk to potential LPs, you say, we are going to look for places where we can, sit in these deals for 3, 4, and 5 years. And that's how we look at them. So I think there's also the symbiosis, which is really, it's one of the best parts about this is it all makes sense, right, to do it this way because you're just structured differently. All right, so let me ask you this now. I would love it on a no names basis because I don't have any NDAs, but it's up to you. So you can be as specific or as vague as you want. But do you have a case, you funded, and on a high level, you feel like, because, obviously, litigation funding's in the shadows and it's dark money and blah, 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 that stupid stuff. And largely it's because, companies keep these things private, whether they fund it. And so, I think we're, giving ourselves a black eye by people being unwilling to try to be more open. Is there a case you were involved in, and it could be very high level, where you felt like, we really helped David versus Goliath, or this is one I felt good about? I'm just kind of interested, just sort of the high points on it.
Sure. I mean, I'll tell you, in the corporate monetization space and in most of what I've done, there's not a lot of David and Goliath. It's right. Goliath and Goliath.
Goliath and Goliath, right.
So I think of it less in terms of, the little guy versus the big guy, and more just in terms of how capital infusion shifts market dynamics in the interest of justice. And I think one of the examples that I feel best about in terms of where litigation finance participated in a market and genuinely made a difference. And I'm saying this without reference to any specific investment or whether I was involved or not, but just the general knowledge that litigation finance was in this space, is in the opioid litigation. So, if you go back to 2016, 17, the earliest days of the opioid litigation, there were some one-off cases that were filed in different district courts with some really bad decisions. I think there was one out of California saying that there was no available public nuisance claim for this type of theory. The basic theory being that the municipalities and the states were harmed by the opioid crisis in the form of increased public cost.
And I want to pause there because this is really important. And I think a lot of people would be surprised that look, state AGs are typically not the counterparties in funding agreements, but state AGs tend to use contingent fee firms, and we know that those contingent fee firms had to borrow incredible amounts of money to prove how people were abusing these opioids. how it worked. And, when you're talking about sort of stakeholders and, whether litigation's funding is good or bad, like if you want your state AG to get you some money for like the PFAS that's poisoning your water, or for like the opioid, like overdoses in your hospital, you should want this capital to exist. So I know I kind of butted in there, but like, that's a really important piece. And I think the opioid litigation, it's hard to find many people who don't think that was, meritorious, especially. And I'm also reading No More Tears now, which if I could link the show notes, I can't, but if I could, everyone should read that. It's pretty bad. So keep going.
No, but that's, I mean, you're absolutely right. So there were some really bad decisions early on. And I think there were a whole bunch of people who were skittish about the litigation. And by the litigation, I mean by the municipal side of the litigation, the recovery from the pharmaceutical manufacturers who created and pushed these drugs on the market, to put money back into the public coffer for what was effectively a public health crisis that was created by their conduct. And there wasn't a clear cause of action. There wasn't a path from feeling certain that people were wronged to actually having money change hands. And to your point, there were firms, the biggest plaintiff firms in the country, started taking these matters on contingency and saying, oh, this is going to be tough. This is going to be expensive. This is going to be a long haul. And litigation finance came into that market early when the risk was very high, when the outcome was completely uncertain. And I genuinely believe made some of those cases possible and some of the earliest successes possible, and the consolidation into the MDL possible, so that that litigation could ultimately prevail and produce, massive settlements that will go back into state and municipal coffers for public service.
And I think more importantly now, like, if you go get a tooth pulled, if they offer you, a 5-month supply of OxyContin, you probably know not to take it, even if it'll cover, right? And it's crazy, like frankly, like the disinformation around it. And so besides the cash, which is obviously important, and treatment centers have been built, and, Medicaid has recovered money, and rural hospitals have gotten money back. But there's also the aspect of this total like disinformation campaign is over, right? It's just over. And without this civil litigation, there's no way, like, period, full stop. So
and it wouldn't. Personal injury claims would not have had the effect that the wide scale coordinated municipal claims had.
Right, because they're one-offs. And if someone's going to go to trial and it's going to look bad, they can settle with one person. They can say, you couldn't prove which opioid you took, and I'm going to sanction you. All that stuff. So no, I think that's right. All right. So do you have any bold predictions for me? So when we're on this in a year and you're having your triumphant return episode after you were the most requested guest of the year, but in seriousness, what do you see sort of in the next year of the business? I mean, there's been a little bit of a shakeout. There's been PACCAR in the UK. There's been talk of tax. I'm just interested sort of what you see going on.
I guess I think that the law firm market for funding is, if not saturated, close to saturated. There are a lot of big firms that have locked up kind of long-term portfolio style deals that they may or may not ever dig.
And they're usually happy for like the first 2 weeks, right? They're usually so thrilled.
They are.
We're going to give you up to $100 million. That's right. It's $1 million, $1 million a year for 100 years. It's great. It's a good deal.
Or they actually got $100 million and they will just never ever pay it back, and then they've got evergreen obligation to put everything into the portfolio.
Well, as I say, look, it's very easy to deploy. It's the getting paid back is the trick, right? Deployment is cake. Trust me.
So I think what you're going to see is that as the law firm market gets more and more saturated, that there is more movement towards the corporate market. I think there's more opportunity there. It's more untapped. I think, we talked before about the trend of corporations thinking more aggressively about plaintiff side litigation about making sure that they're maximizing recoveries that they owe their organizations. So, you know, in a self-serving manner, I have certainly seen that trend, and I think it will continue. Yeah, that's what I see.
Okay. Well, I really want to thank you for coming on today. So, you know, I mean, I'd tell you what their website is, but you'll find them, right? Find her on LinkedIn. Call me if you don't know Kelly. I'll introduce you to her. That's fine. But thank you for coming on. I really appreciate it. We'll talk soon.
Thank you for having me, Ted. Take
Bye.
care.